The federal budget deficit will decline by $155 billion in 2013, according to a new Congressional budget report. The upcoming spending cuts, along with new tax increases, will shrink the deficit and slow economic growth this year. Congressional Budget Office Director Douglas Elmendorf spoke to reporters about CBO's latest projections.
Hello. Thank you all for coming. I'm Doug Elmendorf, the Director of the Congressional Budget Office. CBO just released its outlook for the federal budget and the economy over the next decade. I'd like to tell you a little bit about it, and then my colleagues and I will be happy to take your questions. Our analysis shows that the United States continues to face very large economic and budget challenges. Under current law, we expect that the unemployment rate will remain above 7.5% through next year. That would make 2014 the 6th year in a row with unemployment so high, the longest such period in 70 years. Also under current law, we expect that budget deficits over the next decade would total about $7 trillion. With deficits so high, the federal debt held by the public would remain a larger percentage of GDP than in any year between 1951 and 2012. By the end of the decade, debt would be 77% of GDP and on an upward path. Let me elaborate on those points, beginning with the economy rather, and then turning to the budget. We anticipate that economic growth will remain slow this year because the gradual improvement that we see in underlying economic factors will be offset by a tightening of federal fiscal policy scheduled under current law. The good news is that the effects of the housing and financial crisis appear to be gradually waning. We expect that an upswing in housing construction, rising real estate and stock prices, and increasing availability of credit will help to spur a virtuous cycle of faster growth in employment, income, consumer spending, and business investment over the next few years. However, several policies that will help to bring down the budget deficit will represent a drag on economic activity this year. The expiration of the 2 percentage point cut in the Social Security payroll tax, the increase in tax rates on income above certain thresholds, and the cuts in federal spending scheduled to take effect next month will mean reduced spending by both consumers and the government. We project that inflation-adjusted GDP will increase about 1.5% in 2013, but that it would increase roughly 1.5 percentage points faster if not for the fiscal tightening. After the economy adjusts to that fiscal restraint, we expect that growth in real GDP will pick up to about 3.5% per year in 2014 and the following few years. But the gap between the nation's GDP and what it is capable of producing on a sustainable basis, what we call potential GDP, will not close quickly at that rate of growth. Under current law, we expect output to remain below its potential level until 2017, almost a decade after the recession started in December 2007. By our estimates, GDP was more than 5% below its potential level in the fourth quarter of last year, a gap that is only modestly smaller than the gap that existed 3 years ago, because growth in output since then has been only slightly faster than growth in potential output. The nation has paid and will continue to pay a very large price for the recession and slow recovery. We estimate that the total loss of output relative to the economy's potential between 2007 and 2017 will be equivalent to nearly half the output produced in the country last year. With the gap between actual and potential output projected to close only slowly, we expect the unemployment rate to stay near 8% this year, to fall below 7% only in 2015, and to reach 5.5% in 2017. Let me turn now to the budget. Under current laws, the federal deficit will shrink in 2013 for the 4th year in a row. At an estimated $845 billion, the deficit would be the first in 5 years below $1 trillion. And at 5.25% of GDP, it would be only about half as large relative to the size of the economy as the deficit was in 2009. Our projections based on current laws show deficits continuing to fall over the next few years, reaching about 2.5% of GDP in 2015, before turning up again to nearly 4% by the end of the decade. A big reason for declining deficits is that federal revenues are projected to grow because of both the expanding economy and changes in tax rules that are scheduled under current law. As a result, we expect that revenues, which were less than 16% of GDP in 2012, will be about 19% in 2015. Under current law, we expect that revenues will then remain at roughly 19% of GDP for the rest of the decade, compared with an average, as shown in the picture, of about 18% over the past 40 years. At the same time, under current law, our projections show federal spending falling relative to the size of the economy over the next several years. Spending that goes up when the economy is weak, like unemployment benefits, is expected to drop off, and the caps on discretionary spending will restrain spending. After 2017, though, spending in our projections starts growing again as a percentage of GDP. The aging of the population, increasing healthcare costs, and a significant expansion of eligibility for federal subsidies for health insurance will push up spending on Social Security and the major healthcare programs. In addition, the return of interest rates to more normal levels will push up interest payments to their highest share of GDP in 5 decades. During the past 40 years, federal spending has averaged 21% of GDP. In our projection for 2023, spending is about 23% of GDP and rising. What would debt look like under those circumstances? We expect that, again under current law, federal debt held by the public will reach 76% of GDP by the end of this fiscal year, the largest percentage since 1950. It will then remain above 73% throughout the decade, far higher than the 39% average seen over the past 40 years. Remember that as recently as 2007, debt was only 36% of GDP. By 2023, with a budget deficit equal to almost 4% of GDP, debt would be 70% of GDP, 77%, of GDP and rising. Rough stability in debt as a share of GDP over the next 10 years would be a welcome development after its sharp upward surge during the past few years. But debt between 70 and 80% of GDP and rising will remain a significant concern for several reasons. First, the crowding out of capital investment will be greater. Lawmakers will have less flexibility than they might ordinarily have to use tax and spending policies to respond to unexpected challenges, like a recession or war. And there will be a heightened risk of a fiscal crisis in which the government would be unable to borrow at affordable rates. Those are all effects of having such a high debt-to-GDP ratio. But second, debt would be even larger if current laws were modified, as they've been in the past, to delay or undo certain scheduled changes in policy. For example, if lawmakers eliminated the automatic spending cuts scheduled to take effect in March, but left in place the original caps from the Budget Control Act. If they prevented the sharp reduction in Medicare's payment rates to physicians from taking effect early next year, and if they extended the tax provisions that are scheduled to expire, then budget deficits would be substantially larger than in our baseline projections. And debt held by the public would rise to 87% of GDP in 2023, rather than the 77% under current law. Third, debt might also be larger in our projections because even the original caps on discretionary funding would reduce such spending to an unusually small amount relative to the size of the economy. And that might be difficult to sustain. CBO projects that with just those original caps in place, discretionary spending would equal 5.8% of GDP in 2023, a smaller share than in any year in at least the past 50. Because the allocation of discretionary spending is determined by annual appropriation acts, lawmakers have not yet decided which specific government services and benefits will be reduced or constrained to meet the specified limits. And fourth, projections for the 10-year period covered in this report do not fully reflect long-term budget pressures. Because of the aging of the population and rising healthcare costs, a wide gap exists between the future cost of the benefits and services that the public is accustomed to receiving from the government, especially in the form of benefits for older Americans, and the tax revenues that the public has been sending to the government. It is possible to keep the policies for those large benefit programs unchanged, but only by raising taxes substantially for a broad segment of the population. Alternatively, it is possible to keep tax revenues at their historical average percentage of GDP, but only by making substantial cuts relative to current policies in the large benefit programs that aid a broad group of people at some point in their lives. Deciding now what combination of policy changes to make to resolve that imbalance would allow for gradual implementation, which would give households, businesses, and state and local governments time to plan and time to adjust their behavior. Thank you. We're happy to try to answer your questions. Yes. Can you say who you are and where you're from, please?
Kevin Hall with McClatchy Newspapers. This is less a budget issue and more your economic projections. There's been a lot of discussion, as you know, about quantitative easing and how the Fed undoes this bold experiment. You're looking at, if I understand your economic projections right, roughly 4% GDP growth at a time where the 10-year yield is somewhere around 5.2% and core inflation is still not getting above 2%. Those three seem hard to line up. Can you talk a little bit about how you, looking at your out years, how you approach this and how different is this than a normal period in our economic history?
This is a highly unusual period in our economic history, of course. We expect that the Federal Reserve will start to raise the federal funds rate in 2016 and start to sell assets out of its portfolio later in 2016 under current law and the budget projections and economic projections that we have in this report. That would amount to an extraordinarily long period of extraordinarily low interest rates. That is what the Fed says it is trying to do in order to provide as much support to the economy as it can, and we expect they will continue to provide that support. The interest rate on 10-year Treasury notes will start to rise sooner, though, we expect, because those rates reflect not just current short-term rates, but expectations of future short-term rates. And we think financial market participants will begin to look more and more to the period after the Federal Reserve has brought short-term rates back up to more normal levels. So we have the long-term rate heading up sooner than the short-term rate does. That is not particularly unusual. We have the short-term rate heading up at a point where we think the unemployment rate would be coming down decisively, and the economy would be working its way back closer to potential output, and inflation would be coming up toward the 2% rate that the Fed is targeting.
But you're not worried? There's been obviously a lot of debate on can they withdraw support and not have higher than normal core inflation. Are you guys looking at past history? Or
we expect that they will be able to reduce the size of the balance sheet and raise interest rates in a way that prevents inflation from going beyond their 2% target. As you know, they have tools they have not had in the past, in particular the ability to pay interest on reserves. But it's hard to look at historical episodes and get a very clear reading because we are in circumstances we have not been in before, and they are doing things they have not done before. Yes?
Bob Samuelson, The Washington Post. You say that the recovery has been so slow that the gap between the actual output and your calculation of potential output hasn't changed very much over the last few years. My question is this pattern of recovery substantially different from previous recoveries? In other words, in previous recoveries, did we reach the potential much sooner than in this recovery? And secondly, you seem to assume that there is going to be a pickup so that we will get to your estimate of potential by, I guess, 2016 or 17?
Yes.
what do you base that on? In other words, if we've been growing less than, if we haven't had that sort of boost above potential until now, why would you expect we would get it now?
So as you know, this is very unusual to have output fall short of potential output for this long. The only previous episode that I'm aware of was in the Great Depression. But if one looks, only previous episode in this country, but if one looks at the experience around the world with financial crises, it is often the case that output remains well below economy's potential, that a lot of unemployment remains high, a lot of resources remain unused for a considerable period of time, while households and businesses reduce the leverage that they had often acquired leading into such financial crises. As we look at the economy, and I think as many private analysts look at the economy today, it appears that the process of deleveraging has gone on to a significant extent. Household wealth is rising now. Stock prices are rising, house prices are rising, mortgage debt is falling. So we think households are in a stronger position to spend than they have been. Business investment was not particularly strong for last year as a whole, but seems to be doing well again toward the end of the year in terms of its growth rate. We think that state and local governments will be providing less of a drag on the economy. We wrote a report last fall about the sources of the slow growth, the slow recovery. One very important factor in our assessment was the cuts that state and local governments have been making in their spending in response to the losses of revenues that they've suffered. So we think that factor is improving. So we think there are a number of elements of the demand for goods and services in the economy that are picking up. The housing market is another important one to mention, although it is rebounding from a low level. It is clearly rebounding at this point. Residential investment is growing, house prices are coming up, house sales are rising. So as we look across the sectors of the economy, we see momentum building. And I think that is consistent with experience in other countries after some period of time in which growth resumes. Now, on top of that in our forecast is the effects of the fiscal tightening for 2013, which this year we think offsets most of that gathering strength in the economy. But we think by the time the economy has adjusted to the tightening this year, again, our projections are made conditioned on current law, then next year and beyond we'll see faster economic growth. There are important risks around that forecast, we think, on both the upside and the downside. But we think it is a reasonable middle ground given what we see in the economy today.
Jonathan Nicholson with B&A. Kind of 1.5 questions, if I could. First, you talked about the fiscal drag from this year. Can you give us any separate point estimates for each of those 3 elements, or at least specifically the sequester, and how much of drag that would be? And also, there's an increase in ag spending from $11 to $23 billion in your mandatory spending. Just was wondering what that reflected, or what that was, what the situation is there.
So on the first question about fiscal tightening, what we've said in the report is that we see a total of about 1.5% of GDP effect of fiscal tightening, which is to say GDP, and remember the fiscal tightening is in our baseline projection, so GDP growth would be 1.5 percentage points faster this year without any of that tightening. We've said that 1.25 percentage points of that comes from the big factors people have talked about, including that we analyzed last fall. That 1.25 percentage points, about half owes to the sequester and about half owes to the increases in taxes from both the expiration of the 2% cut in the payroll tax and higher tax rates on higher incomes. And then the remaining 0.25 percentage point is due to a collection of other factors in the budget. So that's the breakdown. That's really as precise as we think we could reasonably be. As for the extra half question, the increase in the agriculture spending, I'm afraid I can't speak to that directly. I don't know if any of my colleagues know that offhand. If not, we'll have to get back to you separately. Yes.
Hi, Jim McTagg from Barron's. I have 2 questions. The first is for a colleague. It's really inside baseball. In your June 2012 report, you had debt to GDP at 200% by 2037. And My colleague wants to know that based on this current report, it sounds like you've pushed that back 3 years to 2040.
So, no, I don't think you can draw that conclusion. Your colleague is referring to our long-term budget outlook from last June, which looks out 25 years and somewhat beyond that. We have not updated those long-term projections yet. We will aim to do that again later this year. So we don't know how the change in the projections for the first decade will affect the path of debt beyond that.
And how do you factor in things like the fracking revolution, or do you not factor in economic circumstances like that?
So we do try to factor that sort of effect in. We actually have a separate analysis underway on the effects of fracking on the economy, and our preliminary insights from that analysis are in this forecast. Our view is that fracking is good for the U.S. economy relative to not having fracking at all, but that the effect is probably smaller than some of the more enthusiastic supporters have said. And moreover, that our economic forecasts don't generally pick out the specific elements of innovation in techniques or shifts in the composition of output 5 and 10 years in the future. We're looking at a sort of cruder approach, which is to try to stack up the labor and capital resources and some sense of overall productivity. So our projections always have in them a certain amount of new ideas coming along that aren't originally foreseen. Given the potential importance of fracking, though, as I said, we are doing a separate analysis of that, which is not quite complete. Yes.
Damien Flynn of the Wall Street Journal. You talked about how debt to GDP is now, around 76%. It's much higher than the average. One of the big debates in Washington, obviously, is how much additional deficit reduction should be done. Do you have a sense, or do you guys have any projections about how much additional deficit reduction it would take to stabilize the debt to GDP?
I'm not sure I know that fact exactly. As we show in our report, I can go back to the crucial picture, the debt to GDP ratio at the end of this year we think will be 76% of GDP. It then declines in our projection to around 73% of GDP and comes back up to 77% at the end. What the right level of debt is relative to GDP is not a question to which economists have an analytic answer. What we have said, consistent with the consensus view in the profession, is that with high levels of debt have costs and risks. The costs, or the crowding out of investment and the reduction in output and income that comes with that. The risks are particularly the inability of policymakers to respond to unexpected developments. Notice that in the last 6 years, the debt to GDP ratio has risen from 36% to 76% because of the financial crisis, the recession, and the policy responses to that. If we were to be running along at 76 or 77% of GDP, and we were to encounter another recession, or a more serious recession and financial crisis, then there would be much less room to move. And countries that find themselves with very high debt to GDP and then encounter economic problems or international circumstances to which they need to respond really find themselves in very bad and dangerous circumstances. So at this level of debt relative to GDP, our country would be incurring costs and bearing risks of a sort that we have not in our history except for a few years around the end of the Second World War. At the same time, bringing debt down relative to GDP requires reductions in benefits and services that we're getting from the government or higher taxes paid to the government. We released another report today that looks at the macroeconomic effects of alternative budgetary paths. And we lay out some alternatives, not recommending any of them, but simply showing the consequences. So another benchmark you might have in mind is, I said we've gone from 36% to 76% between 2007 and 2013. Suppose that you wanted to reverse that run-up, and we're pretty patient, so you would wait to do it over, say, the next 40 years. So we'd be taking down 40 percentage points of GDP over 40 years. Say you want to do this at 1 percentage point per year. That's not optimal policy in any sense, but just a feel for magnitude. That kind of reduction would then lead you from 76% at the end of this year to, say, 66% at the end of 2023 over these 10 years. Well, that 66% is compared with 77% in our current law baseline. So you would need to get that slight downward slope, you would need to reduce debt by 11% of GDP in 2023. That's about $2.75 trillion. And if you did this gradually, you'd have some debt service savings when you got to 2023. Over this period, it would build up. But you would still need maybe $2.25 trillion of savings from lower benefits and services or higher taxes over the decade to put debt on that sort of gradual downward trajectory. And some people would argue that we shouldn't push debt down that far, and they're implicitly saying they are comfortable or willing to bear the costs and the risks. Other people will say that we shouldn't wait so long. We shouldn't be on a 40-year path to return debt to where it has been relative to GDP. We should do it faster. And they're implicitly saying that they're willing to accept larger cuts in benefits and services or larger increases in taxes than are built into current law. And that's a choice that we as citizens need to make and that our elected representatives need to make on our behalfs.
I'm Ben Potter from the Australian Financial Review. I take it from what you're saying that you're not buying, there's an argument around, I think, from the administration and some think tanks and various people that the US government is within short lunge of the goal line after all the work that's been done, and and by the way, the goal line has become stabilising the debt rather than reducing it. So I take it you don't buy that. The other thing is the way you've reduced your medium-term growth projections and raised the Treasury rate projection. To what extent has that undone some of the deficit reduction efforts that have been made over the last 2 years?
So on the first point, we've said many times and still think that the minimum requirement for sustainable fiscal policy is a stable ratio of debt to GDP. As we've said before, debt cannot continue to rise relative to GDP indefinitely. And over this decade, we're showing a ratio of debt to GDP that is roughly stable. But as we say in the report, and as I opened with here, there are costs and risks of maintaining debt at that level. Moreover, as you can see in the back half of the 10-year window, and we'll see in our next long-term budget outlook, although I don't know that we haven't quantified it yet, you'll see that deficits are rising and debt is rising relative to GDP. And that's because the underlying forces that are widening this imbalance, the aging of the population and rising spending on healthcare, those forces are still at work. So although over this decade, debt looks roughly stable as a share of GDP, you can see it in the second half of the decade and from the work that we and many other people have done about the forces driving the budget, that is not going to last. As far as our revisions to the economic forecast, our economic forecast is stronger in the near term because the legislation enacted at the beginning of January took away a large share of the fiscal tightening that was scheduled to occur this year and that we had built into our forecast last summer. So our economic forecast is brighter in the near term because the fiscal tightening has been reduced. It is not quite so bright near the end of the budget window. In our outlook, in the appendix, we break down the effects of different factors in changing our budget projections. And I think the net effect of the economic factors was slightly positive but small in terms of the 10-year deficit. But far and away the most important thing that happened between our last projection and this one was the enactment of this legislation in January. And I think the second most important thing that happened was our revisions to spending in some of the federal government's health programs. Yes?
Yeah, Darren Gershon at the Business Report. Doug, do you have an estimate of if you have $1 trillion in deficit reduction, what kind of job growth that creates over 10 years? Did you make that kind of projection or not?
So we have not done any estimates of the effects of the different 10-year paths on job growth in this report we released today. We have done estimates before of the effects on employment of changes in fiscal policy in the short term. In this report, on the outlook where we talk about the extra 1.5% of GDP that we would have, we think, at the end of 2013, if not for the fiscal tightening, that extra 1.5% of GDP would translate into about 2 million additional jobs by the end of 2013 if none of the fiscal tightening that is scheduled in current law actually took effect. And that estimate is quite consistent with the estimates in the report we released last fall about both the output and employment effects of the components of fiscal tightening that were in place then. And maybe to be just a little more specific, of that 2 million jobs total, again, most of that is due to the combination, maybe 1.5 million of that or so is due to the combination of the sequester and the tax provisions. And those effects are each about half of that 1.5 million, and the other 0.5 million comes from these other collection of smaller policies that are contributing to fiscal tightening.
So if you're fairly certain we're giving up 1.5 million jobs, 2 million jobs this year, what certainty do you have that we're going to gain them back in future years from the deficit reduction we're seeing now?
So first of all, I'd like to emphasize that we are not fairly certain of these numbers. We are making the best estimates that we can, and in fact, in much of our work about the economic effects of fiscal policy, we report ranges of estimates precisely to show the uncertainty that those estimates involve. But we think that right now, the economy is suffering, as it has for the last several years, from a shortfall in the demand for goods and services, a lack of desired spending by households and businesses and governments, and the Federal Reserve has been trying to offset that weakness in demand with stimulative monetary policy, but has faced limitations that you're all aware of. So under those circumstances, withdrawing demand by households and by the government through higher taxes and through sequestration, we think makes that gap between actual and potential output larger and pushes the unemployment rate up. But as we look out 5 and 10 years from now, we think, for reasons I discussed, that the underlying economic momentum will bring the economy back toward potential output, will bring the unemployment rate back down, will allow the Federal Reserve to bring interest rates, the short-term interest rate back up again. And under those circumstances, then fiscal policy has somewhat different effects on the economy. Under those, in the medium run and long run, then the way the fiscal policy can best contribute to economic growth is by reducing borrowing, freeing up funds for investment, and perhaps by changing the incentives to work and save that are in tax policy and in federal benefit programs. So they're just different economic circumstances over the next few years relative to later on. And we think that the policies that would restrain growth today, but would also bring down deficits, would ultimately be beneficial once the economy returned to its sustainable level of employment and output. Yeah.
Thanks. Kind of along the same
tell
lines.
us who you are.
Oh, sorry, it's Lisa Mascaro from the LA Times. The House Republicans are considering a budget this year that will have a 10-year balance. And I'm wondering if you could address at all, without obviously singing that, what the budget and economic implications of that could be. And is that time window of 10 years, how does that sort of mesh with some of the examples you've given earlier about, like a 1% reduction over 4 years, something like that?
So our baseline projection of the deficit for 2023 is about $1 trillion. So to balance the budget in 2023 would require a reduction in the deficit relative to current law of about $1 trillion. If one got there gradually over the course of the next decade, that might involve deficit reduction over the course of the decade on the order of $4 trillion relative to current law. And in fact, in the other report we released today on the macroeconomic effects of alternative budget paths, we had an example that we picked independently of any particular discussions on the Hill of one of our examples was $4 trillion of deficit reduction that ends up reducing deficit by a little more than $900 billion in 2023. So we also had paths that showed a $2 trillion cumulative reduction and a $2 trillion increase. We looked at a range of possibilities. So the amount of deficit reduction required to balance the budget in 2023 is naturally a large number. And if one starts not from one's mind, not from the current law baseline, but from some extrapolation of current policies, then the deficit reduction required would be even greater. The economic effects of that depend importantly on the timing and on the nature of the changes in policies. So our analysis today of the macroeconomic effects of alternative budget paths explicitly looks at just total amounts of deficit change. It does not incorporate any specific proposals' effects on incentives to work and to save. Those factors can be important in specific policies, and we analyze those in specific policies. So that whatever the policymakers would do to reduce the deficit, the economic effects will depend on how they do it. But also, as I said, it depends crucially on the timing. Sharp deficit reduction in the next few years, given the large amount of slack remaining in the economy, given the constraints on the Federal Reserve's actions, would reduce output and employment in the next few years by our estimates. And that's consistent with the work that we've done on the Recovery Act. It's consistent with the analysis we've done several years running on different policies to stimulate the economy and to increase output and employment. I think it's consistent with the consensus of thinking in the economics profession. So deficit reduction in the short run would have negative short-term effects on the economy. Deficit reduction later would have positive medium and long-term effects on the economy. So the set of effects that would occur over a decade in response to a particular budgetary path would depend on when those reductions occurred, in addition to the composition of the changes in policy. And I don't mean to be vague, but there is no more explicit answer that would apply to any possible way of achieving the goal you mentioned. Yes.
Here, New York Times. You talked a little bit about on page 42, the estimates of interest rates for Treasury bills and notes, and here, when the government's cost of borrowing will go up, and why you think it will go up when it has stayed so low for so long?
Happy to do that. There's actually an appendix which gives the year-by-year economic projections, and people who wanted to flip to page 64 can see on a year-by-year basis what's happening to interest rates. They're about 2/3 of the way down in that table on page 64. You can see, as I mentioned before, that the short-term interest rate, we show the 3-month Treasury bill rate here, stays extremely low through 2015 in our projection, but then moves up rapidly in 2016, 2017, and then in 2018 is up at 4%. And that happens in our forecast because we think the strengthening economy, by 2016, the reduction in the unemployment rate, we think will have occurred by then, and will lead the Federal Reserve to tighten policy. In addition to the increased interest rates that you can see reflected here, we also think the Federal Reserve will start to sell assets from the portfolio beginning in 2016. The long-term interest rates move up basically in anticipation of that path of short rates. So we think market participants who expect the Federal Reserve to raise short rates will start to raise long-term rates ahead of that. That's why the long-term rate starts up a tiny bit this year, more next year, and in 2015. And at the back half of this 10-year window, we end up with both short and long-term rates that are 20 basis points higher than the rates that we had in our August projection, and that is because of the higher levels of debt relative to GDP than we had in our August baseline projection based on then current law, which showed much smaller deficits. These long-term rates are also higher in real terms than we've had on average in this country over the past several decades, and that also reflects a higher amount of debt, federal debt, relative to GDP than we've had on average over the past several decades.
Laurie McEvoy with the Washington Post. So having trouble on thinking about how we should view the budget battles of the last 2 years. So to the extent that we no longer have trillion-dollar deficits and we're stabilizing debt at a much higher level, to what extent is that the result of the decisions that have been made by lawmakers, and to what extent is it the result of an underlying recovery in the economy?
I think it's both factors, and we have not tried to quantify them. One can look at our projections over the past set of years and basically add up each successive revision. So every time we release new budget projections, we report the revisions from the previous set, and we divide them into the effects due to legislation, changes in our economic forecast, and changes due to other factors, which we call technical sources of revisions. If one stacks all those up, then one can get a sense about how much the debt has changed or the deficit has changed for any given year relative to any particular past projection that one would look at. We have not tried to do that. I mean, certainly an important part of what's happening is the economy is strengthening. So revenues are a larger share of GDP in 2013 than they were in 2012 in our projections here. Another factor is that some specific pieces of legislation had effects on the deficit that have now passed or are passing. So the Recovery Act is an important example of that. Enacted in 2009, but with spending that occurred over a number of years, and an important source of reduction in some categories of spending over the past few years has been the tailing off of the extra outlays that occurred under the Recovery Act. Then there also have been, of course, caps established, cutbacks, and then caps established on discretionary spending. But to really parse out, to quantify, have a quantified answer to your question, we would need to be specific about what the starting point was you had in mind, and also about what the comparison you have in mind is. So, as I said, we report revisions to our baseline projections, but people may have other starting points in mind. They may want to be starting from something else, and then you have to do a different set of calculations. So we don't have a view about how much has been done in that sense. We are really focused on what we see as the issues from here forward.
Tom Curry with NBC News. You say a number of points in this report. You talk about the historical experience of the last 30 years, 40 years with debt and spending and whatnot. Going back to the 10-year Treasury, you're saying by the end of this budget period will be 5.2%. The 40-year average is something like 7%. Do you look at that average and say?
What I hope I said, what I meant to say certainly was that after adjusting for inflation, we have a real interest rate on the 10-year Treasury note projected for 23 that is higher than the average real inflation-adjusted rate on Treasury notes in the past. But an inflation rate of 2% is lower than, of course, the inflation rates that we've seen at some points in the past. So I don't know. I think you're making a comparison of the nominal interest rate, and I just don't have those facts at hand. I think the way we think about this is to think about what inflation we think there will be, and to think about what we think real interest rates would be, and to add those pieces up to get a projection for nominal interest rates. Yes?
Hi, Nancy Cook, National Journal. Just back to the idea of what it would take to balance the budget in 10 years. Could you accomplish that through just cuts to non-defense discretionary spending, or will that require in 10 years changes or significant cuts to entitlement programs?
Well, that's a good question. So in our projections, so there's a table that shows discretionary spending year by year and total over the period. So it's table 1.5. And I'm guessing page 23 or thereabouts? 26 and 27. So you can see there, if you look at the right-hand page, page 27, two-thirds of the way down, there's a total for non-defense discretionary spending in our baseline. And that totals $6.4 trillion over the 2014-2023 period. So if one were to aim to achieve $4 trillion in deficit reduction, not counting interest, but just in the policy changes, and one wanted to achieve $4 trillion in deficit reduction out of that category, it would require about a two-thirds reduction in non-defense discretionary spending relative to our baseline. If one tried to do it out of discretionary spending as a whole, which you can see at the bottom of the table amounts to almost $13 trillion, then a $4 trillion cut would be about 30%. And I said that $4 trillion is, in this alternative paths that we looked at, would end up with a deficit that was close to zero in 2023. But whether that particular time path is the one that anybody might actually decide to do, we don't know. For those illustrative purposes, we simply picked some simplistic linear paths of deficit reduction. But the gap between spending and revenues is very large, and that means that changes, the changes you would need to eliminate that gap will be large relative to either outlays or taxes. Would even require large changes if one split the impact across spending and taxes, even if one split it across spending and taxes. The changes in policy needed to balance the budget are very large. And even the changes needed, as I discussed, to bring debt down gradually as a share of GDP would be significant changes. Yes.
What would so if you just cut, let's say, $4 trillion from non-defense discretionary spending, what would the federal government look like then at that point?
Well, it would look like a much smaller thing than it looks like now. I mean, remember here, this non-defense discretionary spending includes a wide array of government activities. About 15% of that or so, I think, is education and training. Another big piece is transportation. Think mostly of highway construction. There's a big piece that's health-related, of which a large share is funding for the National Institutes for Health. There's a big piece of that that's veterans health care. There's a piece that is involved in international affairs, a piece that's administration of justice. An awful lot of different activities. Just what the government would look like would depend on how those cuts were distributed across those various activities. One of the points we make in the report is that the caps on discretionary spending and then the sequester on top of that would reduce both defense and non-defense discretionary spending to extremely low levels as a share of the economy relative to what we've seen over the past several decades, but that policymakers have not confronted yet just what programs would be eliminated or reduced to meet those overall totals, because that spending is, because the funding for that spending is only provided by Congress in annual appropriation acts. No decision has been made, or really could be made, about exactly what will be cut later. And one of the risks that we see in our budget outlook is that when it comes down to making those specific decisions about what programs will go away or be greatly reduced, that it will prove quite difficult to meet these targets because they are so low by historical standards.
Sorry. Could you talk a little bit about what's going on with healthcare costs? Do we know anything more about why they're slowing? Health spending has grown slowly over the past few years, both in federal programs and in the rest of the healthcare system. We think that part of that owes to the recession and the loss of income and wealth, but we think that a significant part of that probably does not stem from the recession, probably arises from structural changes in the healthcare system. The critical question is whether those structural changes are very transitory changes or whether they will persist. We're doing analysis of that question. We're talking with outside experts who are also investigating the same question. I think the short summary of that is that we don't know. The slowdown is fairly broad-based. Again, we've seen it in public programs and in private programs. And within public programs, it's fairly broad-based. So we've seen it in the part of Medicare that pays for hospital care, the part that pays for physician care, the part that pays for drugs. But that still doesn't tell us, and doesn't tell other people, really what's going on in a way that would let us draw firm conclusions about the duration of this effect. So what we've done in our projection, we mentioned this in the end in Appendix A, we talk about the revisions to our projection. We say that since early 2010, we've been surprised by slow growth of spending in the federal health programs. In 2012, Medicare and Medicaid spending were each about 5% less than we'd expected they would be in 2012, back at the beginning of 2010. So we've seen that savings already.
And then we have, over the past few years of watching those data come in, gradually marked down our projection for health spending in the future. So since early 2010, we've taken down our projection of Medicare and Medicaid spending in 2020 by about 15%. That amounts to about $200 billion. For this reason, there are other changes, of course, in our health projections, economic factors, legislation, and so on. But the changes that we label technical, the ones due to our observation of the slowing growth, have led to a reduction in Medicare and Medicaid spending, each about 15% in 2020. So we do expect some of the slow growth we've seen to continue for a while, but we don't know. This is one of the sources of great uncertainty in our projection.
Is it accelerating, or is it just sort of, I mean...
I would say that it has been, I think the best way to characterize is the growth has been slow for the past few years, and slower than we and many analysts had expected a few years ago. I think looking for, in our analysis of trying to pin down the causes, we are trying to turn up the magnification on that, but I think one has to be very careful about that, because there's an awful lot of movements in the year-to-year growth rate of spending in healthcare over time that have not gone anywhere after that. So I think we all should be careful about drawing too much conclusion from the particular timing. But we have seen enough now for a long period of time that we think that it is something real and not just related to the business cycle. We just don't know how long it will last for.
How is Medicare absorbing the baby boomers? Is it because the younger boomers are paying in more than they're bringing out? Or, I mean, it seems counterintuitive to think that...
Well, so when I talk about the slow growth, what I'm talking about is really the growth in spending per person. So we're abstracting from the things that we could predict, like how many 65-year-olds there would be now. We are at just the leading edge, baby boomers being eligible for Medicare. What is true is that the 65-year-olds and 66-year-olds tend to be healthier than the average Medicare beneficiary. So there will be some slowing in, some reduction in Medicare growth, in Medicare spending per beneficiary from bringing in a lot of people at the younger end. Let me try to be clear about this. The aging of the population is greatly increasing the number of beneficiaries in Medicare. But relative to the overall number, what is particularly increasing right now are the young ones. They tend to be less expensive than average. But those are factors that we could reasonably anticipate and think that we had incorporated into our projections. So the things that are surprising us and surprising others are the cost per person after adjusting for those factors.
Where does that leave the growth rate, I'm sorry, in healthcare spending? It had been something like 6%, and now it's...
So we have a nice statistic in here that Medicare spending, I think it's here, yes. So since 2009, spending for Part A and Part B has risen by an average of 2.9% per year. This is on page 57. I'm sorry, page 57, footnote 6 in the right-hand column. Since 2009, spending for Part A and Part B has risen by an average of 2.9% per year, compared with average annual growth of 8.4% from 2002 to 2009. And we focused on Parts A and D there because Part D was introduced in the middle of that earlier period.
How much did death panel save us?
What the federal government might do to reduce federal health spending further is, of course, a topic that we do a lot of work on, and there are different avenues that might be pursued. And it is maybe worth emphasizing here that despite the slowing in growth, we still see substantial growth in federal health care spending over the coming 10 years and beyond. That is importantly because the number of people who will be eligible for Medicare will be rising very sharply. And this is true for number of people rising, of course, matters for Social Security as well. In 2023, there will be about 40% more people receiving benefits through the old age and survivors insurance part of Social Security than received them in 2012. A 40% increase. Those people will largely be in Medicare as well, and in Medicare but the the effect in Medicare depends, of course, not just on the number of people, but also on the cost per person, the factors we've just been discussing.
That was in 2023?
2023 relative to 2012, 40% more beneficiaries in the OASI portion of Social Security. So the disability insurance, the DI portion, is growing more slowly. So just the numbers of people who will be receiving the Medicare subsidies for their health care are growing so rapidly that costs will grow rapidly, even if cost per person doesn't grow at all. Medicaid is also affected by the aging of the population because it pays a significant share of long-term care for long-term care in this country, a significant share of nursing home bills in this country.
In your estimates, you have taxes going to 19% of GDP in a couple of years, which is a 1 percentage point greater than the average of the last 40 years of 18%. What is the reason for that? And the second question is, you project under current law that the deficits over the next decade are roughly $7 trillion, but you don't have a number for what you used to have, the alternate fiscal scenario. And I'm wondering whether you would give us an actual number if you include some of the current policies being continued.
Yes. So we do actually have an alternative fiscal scenario in this report, but we've given it less prominence than we've given that in the past. We offer, as we have many times in the past, a long table that shows the budgetary effects of particular changes in policy. And the last row of that table is labeled the alternative fiscal scenario. So this is on page 33. Change in deficits from the alternative fiscal scenario. It's on the right hand, on page 33, just above the memorandum lines. And you can see, Bob, that on the far right side, that set of policies would add $2.088 trillion to deficits over the decade, and there'd be about $450 billion of debt service. So the deficits as a whole would be about $2.5 trillion larger than we show in the baseline. And that alternative scenario includes all of the pieces, essentially, of our previous alternative scenario that have not now been enacted into law or allowed to expire. So it includes the effect of the tax provisions that are still scheduled to expire. It includes the effects of the sequester, and it includes the effects of the Medicare's payments to physicians.
And the 19 and the 18%?
So I don't think there's a simple answer to the question about why more revenue will be collected. Our income tax system, left to its own devices, will generally show over time a larger share of income being collected in taxes because of what's sometimes known as real bracket creep. As real incomes rise, even with tax brackets indexed for inflation, people will tend to get pushed through real income growth into higher tax brackets and pay more. So one of the reasons that tax revenues rise over the coming decade is this real bracket creep. But if one compares the next decade to the past set of years, Bob, then you need to think about a whole collection of changes in tax policy that have taken effect, as well as changes in the economy, shifts in the distribution of income, and so on. So I don't have a decomposition of that.
Eric Wasson from The Hill. The news of the day is squabbling about the 2013 sequester, talking about small ball president chipping away at the problem today. Is it fair to say that your report in some way argues that we should go back to this grand bargain idea of multi-trillion-dollar things to lock in some deficit reduction now? Would that be better a way to approach this than the small ball they're playing today?
So we're not making any recommendations about policy because we don't do that. I think the policies that people pursue depend on their judgments about the role of the government and, of course, depends on their assessment of the political possibilities. And those are issues that we have no special expertise in and don't engage in. I think what our report does show is that we have a large budget imbalance. We have large projected deficits, a debt that will remain at a historically high share of GDP, and will be rising at the end of the coming decade. I think what that implies is that small changes in budget policy will not be sufficient to put the budget on a sustainable path. But what What sorts of changes should be made when to address that, not our place to say. Beyond, I think, the simple line I finished my opening remarks with, which were that the sooner decisions are made about any given changes that will take effect, the more time that households and businesses have to adjust to those changes. We are living now through a gradual increase in the full retirement age for Social Security that was put into law 30 years ago. And not everybody, of course, has been carefully planning ahead their retirement for 30 years, but I think the idea that there were changes underway that might change people's behavior, I think was important. And if one pushes sharp changes in benefit programs, one raises the risk that people will not be able to adapt to that. It's worth remembering here that I would say because of that concern, I think changes in certain retirement programs are sometimes only made for people under a certain age. And it's worth realizing in that connection that the baby boomers are starting to retire now. 60% of baby boomers are already age 55 or older. In 5 years, 75% will be age 55 or older. So as one thinks about possible changes in benefit programs for older Americans, we really are just at the point where we will either make changes to people who are either already in or about to be in these programs, or we will not be making changes for this very large part of the American population whose retirement is a fundamental cause of this increase in costs. And but again, that doesn't say what ought to be done. It simply illustrates, which is our job, to illustrate the consequences of alternative policy actions.
Kevin Hall, McClatchy. You had mentioned 30 years in coming to plan for that change in the official retirement age. A lot of the proposals out here have pretty much people who are 50, who are under 50 at this point. 50 is the cutoff. That gives people roughly 17 years to prepare for the change. Have you looked at any point at what the appropriate age is? 50, 55, 45? How much build-in have we historically when we're making these changes to entitlement programs?
I don't know. I mean, I think the example of the Social Security eligibility age is one of the striking examples of a change being set in motion a long time ahead of its effect. Obviously, other changes, smaller changes, are made frequently. I don't have a broader sense, I'm afraid, of what sorts of changes we've made. I think part of the point here, though, is that we are confronting now in our country changes of a sort that we have not had to make in the past. So if one looks back over the last 40 years and just leave aside the effects of the financial crisis and recession, so sometimes I give talks where I end in 2007, if one looks at the few decades before that, we had rising spending on Social Security and the major health care programs that was offset as a share of in terms of the shares of GDP by decline in defense spending. So in a sense, we made budget room for extra spending on those programs in the past by reducing the share of the economy's resources that were being devoted to defense. But that's not a strategy that can be repeated at that magnitude over the next 40 years because defense spending has come way down as a share of GDP and because the demographic pressures on spending for those programs are so intense. So we had never really confronted I think quite the pressure to either change spending on those programs or to raise tax revenues in the way that we're confronting it now. Other questions?
Thank you.
Okay. Thank you all very much for coming.